In the last few trading sessions, something happened that almost never happens at this scale. A huge chunk of paper silver didn't stay paper. It got turned into real physical delivery requests, fast. And when physical metal starts getting pulled off the table this aggressively, the price doesn't move in a straight line. It starts acting like a lie detector. So here's exactly what we're talking about today. Why silver is likely to swing violently over the next 2 weeks, why those dips may get bought instantly, who may be standing there ready to take delivery, and why the real story isn't the daily price candle. It's the quiet battle over who controls the actual metal. Now, right after this first part, I need 10 seconds from you, because I'm running a campaign to wipe out copycat channels that steal content and confuse the audience. If you value the work I do, hit subscribe and drop a comment that says OG John AG so I can see who's really riding with us. Also, if you want daily updates, quick posts, and my personal analysis that I don't always put on YouTube, plus instant voice notes when something breaks, my WhatsApp channel is live. The link is in the description. Join it, because some of the most important moves happen between uploads. All right, now let's jump in. Silver is about to look like a heart rate monitor. Up, down, snap, fake out, rip, drop, and then rip again. And the reason I'm saying 2 weeks is because multiple forces are colliding at the same time. Fresh capital getting redeployed, big players repositioning, and physical demand that doesn't care about your candle patterns. Because here's what most people miss. They stare at silver like it's only a trader's toy, something you scalp for a few dollars. But in the real world, silver is an industrial necessity, and industrial buyers don't panic sell the way retail does. When they see a pullback, they don't get scared, they get excited. That's why every time silver dips, it's not just random buyers stepping in. You've got international demand sitting there like a trapdoor. And one of the strongest pockets of demand continues to come from Asia, where manufacturing and tech supply chains treat silver like a required ingredient, not a speculative bet. So while social media is screaming crash, the quiet buyers are looking at the same dip and saying, perfect, load the truck. And that matters even more right now because of the January effect. January is when a lot of funds redeploy, budgets refresh, allocations reset, strategies go back on, money that was parked, hedged, or waiting gets pushed back into the market. And when that kind of capital meets a metal that already trades like it's under tension, volatility doesn't just increase, it explodes. Now add one more ingredient, the gold direction. Silver can run on its own for short periods, but the broader precious metals tone is usually anchored by gold. Gold is the heavyweight that sets the rhythm, and silver is the lightweight that throws wild punches when the bell rings. So if gold keeps climbing, or even just holds strong, silver tends to get permission to become reckless. And this is where the targets conversation comes in. You'll hear price calls all day, $35, $39, $50. And yes, people are throwing around $100 again like it's some fantasy. But let's talk about why those numbers keep showing up, because the logic isn't random. One way people frame it is ratios. If gold climbs toward the multi-thousand range, and silver returns to a historically normal relationship with gold, you start seeing numbers that look unbelievable to anyone who only remembers the last couple of years. A 50-to-1 relationship with a very high gold price can put silver into triple digits without needing a miracle. And then there's the deeper argument, scarcity. Silver isn't just rare emotionally, it's rare geologically. If you compare how it comes out of the ground versus gold, silver's true scarcity profile can look completely mispriced at today's levels. That doesn't mean silver has to instantly correct to some perfect number, but it does mean the long-term pressure points are real. But here's the twist. The big story isn't the math. The big story is behavior. Because while people argue over charts and ratios, something else has been happening repeatedly, month after month, quietly, consistently, and at a scale that's hard to dismiss. Physical delivery. Most futures contracts never end in delivery. Historically, the vast majority get closed, rolled, netted, settled, and moved around on paper. That's been the normal plumbing for decades. Real metal rarely changes hands through those channels because the system was built to be a paper marketplace with just enough physical credibility to keep everyone calm. But lately, we've been watching a different movie. Instead of a tiny fraction of contracts standing for delivery, the market has been seeing repeated waves where delivery requests surge again and again, and the volumes have been strong enough to make even seasoned participants raise an eyebrow. And when that happens, you have to ask the question that almost nobody wants to ask out loud. If this is normal, why is it happening so consistently now? Because the moment physical delivery becomes the focus, it changes the game. It takes the conversation away from price discovery and moves it toward resource control. Think about it like this. Paper metal is easy. You can create exposure. You can hedge. You can short. You can trade it 1,000 times before lunch. Physical metal is different. If someone takes delivery and moves it into a category where it's not offered for sale, that metal becomes effectively unavailable to the open market. It's not a number on a screen anymore. It's inventory locked behind a door. And if you watch the flow closely, a lot of this metal doesn't just sit there. It often leaves the exchange ecosystem entirely. It gets pulled out of the available world and placed into the strategic world. Now, pause on that, because this is where most people lose the plot. They hear deliveries and they assume it's just housekeeping. They assume it's internal shuffling. They assume it's the same old routine. Sometimes that's true. There is absolutely a thing where metal moves between institutions, vaults, accounts, big players shifting inventory around like cards on a table. And yes, some of that movement looks dramatic, but doesn't change the real supply picture. But that's not the whole story. Because even after you filter out the noise, the repeated pattern remains. Unusually large amounts of gold and silver are being demanded physically through channels that historically rarely delivered at scale. And if that doesn't wake you up, nothing will. So then comes the next question. Who is taking it? Is it retail stacking in the basement? No. Is it some random influencer? No. Is it a couple of loud speculators trying to recreate an old squeeze story? Not like this. When you see sustained demand for delivery at this magnitude, the likely candidates narrow quickly. Industrial users securing supply, large institutions positioning for constraints, and entities whose decision-making is tied to national strategy rather than weekly profits. And that's why this moment feels different. Because this isn't just a trade. It's starting to look like procurement. And procurement doesn't care about your RSI. Now, here's where it gets even more interesting. Policy is stepping into the silver conversation in a way that most people still don't fully respect. Silver has been increasingly discussed in strategic terms, critical inputs, industrial dependence, supply chain security, and when governments begin treating a metal like a strategic resource, the incentives change overnight. Export rules tighten, licenses become harder, domestic priorities rise, and suddenly, the metal that used to flow freely to the global market starts getting redirected inward. That's one of the biggest reasons the next 2 weeks could get chaotic, because when trade routes tighten and physical demand remains firm, the paper market can whip around trying to price something that's becoming less available in reality. And this is exactly why you're seeing so much attention on Asia and the industrial pipeline, because if refiners and exporters face tougher rules and fewer entities are allowed to ship, and state-backed priorities get first claim, then the open market gets what's left, not what it wants. And when the open market gets leftovers, volatility increases. Now, let me say something clearly, because this needs to be understood. Not every big number you hear about delivery is automatically a system-breaking event. People exaggerate. They misunderstand how notice days work. They don't know the mechanics. They repeat headlines like parrots, so balance matters. But the flip side is also true. Dismissing everything as nothing is how people get blindsided. The real skill here is separating signal from noise. And the signal isn't a single day. It's repetition. It's the fact that this isn't a one-off headline. It's been happening again and again, and the persistence is the point. Because repeated behavior is not an accident. Repeated behavior is a strategy. Now, quick break, because I want to plug something in a creative way without derailing the flow. If you're someone who loves silver-related success stories, real people, real moves, real outcomes, there's a separate channel linked in the description where those stories are shared. If that's your vibe, go subscribe over there too and binge a few. It'll change how you think about what's possible. All right, back to the main point. When you combine fresh capital redeployment, rising strategic behavior around physical delivery, tightening export pathways, and industrial demand that treats dips like a gift, you get a silver market that doesn't move politely. You get sharp spikes, sudden slams, and snapback rallies that punish both bulls and bears who are over-leveraged. And that's why I'm telling you, emotionally prepare for ugliness on the chart, and strength underneath the chart. Because the strongest markets often look the worst while they're building energy. Now, let's talk about the $100 silver idea without turning it into a fantasy pitch. A lot of people hear $100 and they immediately roll their eyes because they're anchored to recent pricing. That's normal human psychology. We treat the recent past like it's permanent. But markets don't care what you're anchored to. If gold continues to trend upward under monetary pressure and silver continues to face supply tensions while being demanded industrially, the upside scenarios start to look less crazy and more mechanically possible. Not guaranteed, not promised, but possible. And when a move is mechanically possible, you start seeing something important happen. Smart money positions early, retail arrives late, and the media shows up at the worst time. That's the typical order. Now, here's another layer that doesn't get enough attention. Even if silver is volatile, that volatility can actually be bullish, because volatility shakes out weak hands. It forces speculators to exit. It flushes leverage. And when leverage flushes, price can rebuild on real demand. If you ever wondered why markets often do a violent pullback before a big run, that's why. They need to remove the passengers who can't handle turbulence. So if the next week looks chaotic, don't automatically interpret that as bearish. It might be the market doing what it always does before it tries to move higher. breaking people mentally. Now, let's address something else. A lot of people in this space get trapped by the headline trap. They see one dramatic headline about metal moving, or a rumor about a shortage, or a screenshot about inventory, and they treat it like gospel. Then when the market doesn't immediately respond, they get disillusioned. That's not how this works. Big shifts happen through accumulation and pressure, not through one viral tweet. And that's why I want you to focus on the repeated pattern and the incentives behind it. If entities are repeatedly choosing delivery instead of paper settlement, ask yourself why. If export rules are tightening, ask yourself who benefits. If industrial demand keeps absorbing dips, ask yourself what happens when supply can't keep up. Because those questions lead you to the real story. And speaking of questions, I want to hear from you in the comments on two things. First, do you believe silver hits triple digits in this cycle? Yes or no? And what would have to happen for you to believe it? Second, if physical delivery is rising, who do you think is the real buyer? Industrial giants, banks, or sovereign players? Drop your answers. I actually read those, and it helps me tailor what I cover next. Now, quick reminder, because I need to keep the community strong. If any of you are doing well right now, whether you made a great trade, built a business, landed a big opportunity, or turned your finances around, share a quick version of your success story in the comments. Not to flex, but to lift the room. People need proof that progress is possible. And now let's talk about what this means for the next 2 weeks specifically. Here's the setup. You have a market that's sensitive to flows. You have participants repositioning early in the year. You have potential supply friction narratives circulating. You have a metal that is both monetary and industrial, meaning it has two engines. So what happens? In this kind of environment, silver tends to do this. It spikes on excitement, it dumps on fear. It consolidates while everyone argues, then it moves again when nobody expects it. That nobody expects it part is key, because the market's job is to hurt the largest number of people possible. It's not personal, it's structural. If too many people get bullish, it punishes bulls first. If too many people get bearish, it punishes bears next. And in the end, it rewards the people who can hold a thesis without emotionally collapsing on every candle. Now, one of the biggest mistakes people make is assuming that price is the only battlefield. It isn't. In metals, the real battlefield is access, access to supply, access to inventory, access to the real thing. That's why delivery matters. That's why export controls matter. That's why strategic accumulation matters. Because even if the spot price is a number, the real world runs on availability. And if availability tightens, the market eventually has to reconcile with it, one way or another. Sometimes that reconciliation shows up as higher prices. Sometimes it shows up as higher premiums. Sometimes it shows up as delays, restrictions, or strange behavior that shouldn't happen in a normal market. But it shows up. And that's why you should not sleep on what's happening right now. Now, I also want to be transparent about something. By the time you're watching this, a members-only video should already be live. In that one, I put all the key updates together in one place without holding back the deeper layer of analysis. If you want the full picture, join the membership and watch it. It's also the easiest way for me to see who's really following closely. And remember, the WhatsApp channel is there for the fast stuff. The moments when something shifts and you need it immediately, not 2 days later. Now let me bring this home with a reality check. Silver doesn't need everyone to believe. It doesn't need the media's permission. It doesn't need retail hype. If the physical story keeps strengthening and the macro backdrop keeps pressuring currencies, silver can move even while people are distracted. And the reason silver moves the way it does is because it's small compared to many other markets. It doesn't take that much incremental demand to cause disproportionate price action, especially when supply is not elastic in the short term. So yes, expect chaos, but also recognize what chaos often signals in metals: stress, pressure, and potential. Now, I'll end with this. If you got value here, do the simple stuff. Subscribe so you don't miss the next update, because the next 2 weeks could move fast. And if you want to support the campaign against copycats, comment OG John AG under this video. It takes you 2 seconds, and it helps me more than you realize. And again, answer those 2 questions I asked, because I want to see where your head is at. Do you see $100 silver as realistic in this cycle? And who do you think is really taking delivery? Take care of yourselves, take care of each other, and I'll see you in the next one.